Have you visited the gym downstairs? If so, you've used Technogym, the European leader in the growing fitness equipment industry and official supplier of the Olympic Games. Sounds like a pretty good investment opportunity, right? Hold your horses. I'm Gabriel from Politecnico di Milano, and we are issuing coverage with a hold recommendation and a year-end target price of €7.8 per share, a 6% downside on current price. 3 pillars drive this recommendation. First, we do identify positive industry trends. However, Technogym is not positioned as to fully benefit from them. Second, the company has a leading position in Europe, but this is offset by a challenging geographical expansion. And third, its outstanding financial health is actually but one side of an overly cautious investment strategy. We'll now introduce you to Technogym and explain why the company's value is already reflected in the stock price. Founded in 1983 by Nero Alessandri, who still owns more than 50% of the voting rights, Technogym is an Italian-based company that manufactures premium fitness equipment and provides an extensive range of end-to-end services. Technogym's products are known worldwide for their design, quality, and made-in-Italy appeal. Indeed, its most premium treadmill can cost as much as $22,000. The company repeatedly increased prices over the past years, with best-in-class margins for the fitness equipment industry, yet is still below luxury company standards. In B2B, Technogym indirectly reaches premium gym members, notwithstanding whether the gym is in a fitness club, in a hotel, or in a corporation. While in B2C, its offering is mainly directed to high-net-worth individuals who value Technogym's high-end brand. The company has global outreach. However, over half its sales are concentrated in Europe, whereas relevant global markets, North America and APAC, reveal smaller penetrations. Alberto now moving to the first pillar of our investment thesis.
Well-being is now a priority for individuals and governments. Good news for Technogym, isn't it? Not really. We analyzed the fastest growing fitness club chains worldwide according to the number of new branches opened last year. 2/3 of them are focused on alternative workout, such as CrossFit, Pilates, and yoga. These gyms have no use for fitness equipment, and therefore are not Technogym clients. The remaining third do not look promising for Technogym either. These are mass-market gyms with an average fee of $45 per month, a far cry from Technogym's B2B customer base that is positioned in the high-end segment with an average fee of $150 per month. Moreover, ever since the pandemic, people are mixing fitness routines, combining home fitness and gym workouts. This is the hybrid fitness market, expected to grow with a 14% CAGR until 2027. To catch this trend, Technogym, historically a B2B company, launched its own app in May 2021 to expand its B2C client base and replicate the gym experience at home. However, we advise 2 problems with this strategy. First, we see a mismatch among Technogym's end users. Are we sure premium gym members will buy Technogym B2C products? Unlikely, as Technogym B2C offer is designed for high-net-worth individuals. In contrast, premium gym members have different spending habits and will look for cheaper equipment to replicate their gym experience at home. Second, Technogym faces strong competition from other gym apps that are more widely used among gym members. Summing up, we see Technogym not well positioned to fully ride these emerging fitness trends. Now, Andrea can explain the second pillar of our thesis.
Looking at Technogym geographical expansion, today it has a 15% market share in Europe. But its main strategic focus is to penetrate North America, where it achieved a 42% sales growth in 2022. However, this is still a post-pandemic recovery, as the growth from 2019 was 11%, below the levels seen in previous years. And we expect this acceleration to continue, based upon 3 main factors. First, in the B2B market, US professional operators buy their equipment from many different specialized suppliers. This is detrimental for Technogym, whose services are interconnected, and their full value only unveils when operators purchase all their equipment from Technogym. Second, in the B2C, Technogym leaning to luxury offer is potentially less valued by US customers. Luxury spending as a percentage of GDP is much lower in North America than in Europe and APAC. Third, we expect a competitive environment in the USA to further squeeze Technogym's growth. Since the pandemic, industry players have indeed boosted their sales, strongly overtaking Technogym. Moving on to the last pillar of our investment thesis, Technogym is a healthy player from a financial perspective, with leading to luxury margins and a strong cash generation history. But what about the future? Cash flows are barely used to promote organic growth. Records show reduction in organic investments in favor of cash accumulation. And they aren't used for inorganic growth either. With a weak M&A history, we do not expect upcoming transactions, contrary to the consolidation trend of the industry. For now, Technogym is using excess cash to deleverage the company and return cash to its shareholders. Now Alberto will show you how we factor their investment thesis into our valuation.
Let's start with revenues. We forecast revenues top-down, focusing on expected market growth and Technogym geographical penetration. On market growth, for the B2B segments, we looked at the fitness equipment market, while for the B2C, we proxy the target market with the number of high net worth individuals, as it better reflects the specific high-end customer base. About geographical penetration, we started from Technogym's pre-pandemic performance, but assuming a slowdown due to the increased competition in the US and market saturation in Europe. As a result, we forecast a 7% revenue CAGR, 95 basis points below the current consensus. Moving on to margins, Technogym has made a strong recovery from the pandemic, with 2023 EBITDA margin expected at 19%. In the long term, we expect it to be 100 basis points lower than the peak levels of 2019, as moving competition on the international level will lead to pricing pressures and increased costs. Margins may also be temporarily affected by the acquisition of an additional production facility, which we believe will represent the only major investment in the medium term, besides capex for maintenance and minor improvements. Now, following these growth assumptions, we developed a 3-stages discounted cash flow model. Using a projected 6% free cash flow CAGR, a 10% discount rate, and a 3% terminal growth, we advise a target price of 7.8 euros and a hold recommendation for Technogym. We stressed this model with several robustness checks. Our sensitivity analysis, Monte Carlo simulation, and Bull Bayesian analysis all reinforce our recommendation. In addition, to assess the market reliance of our DCF, we carried out a relative valuation. We use it only as a support metric due to Technogym's unique positioning. And now, Giulio will run you through it.
Two peer groups in our market valuation, fitness companies and luxury companies, given Technogym's leaning to luxury positioning and the high net worth individuals targeted by the company. Using the EV on capital employed multiple, we ran a multiple linear regression, applying ROCE and the EBITDA margin to discount differences in the peer groups. In this way, we derived a stock price range of 7.2 to 7.9 euro per share. This reinforces our view that, as of today, Technogym is trading more as a luxury peer rather than a fitness peer. Is this meant to last? As the sales exposure to North America grows, so does the percentage of investors from this area. Hence, we expect Technogym to be progressively traded more as a fitness peer in the long term, bringing the target price closer to the lower valuation. Coming to ESG assessment, we developed a framework, taking as our starting point the metrics and methodologies used by primary ESG rating agencies. We give Technogym a double B rating in both industries, given its lack of disclosure in official documents and the consequential qualitative rather than quantitative reporting style. Looking at the first ESG pillar, Technogym's disclosure on its main environmental issues is restricted to its levels of consumption, but never expands into any consumption reduction targets. Moving to the social pillar, where Technogym scores fairly, the company focuses on collaborating and supporting stakeholders and the community. Here also, it misses out any improvement target. And what about governance? Lights and shadows. The Alessandri family controls 50.5% of the voting rights and holds a number of board positions, opening a discussion on conflicts of interest. Also, as the owner runs the company like a one-man show, investors could see this as a risk. Technogym is a successful European fitness company, but it misses important industry trends. It does face stiff competition in its global expansion, and its priority to return cash to its shareholders may indicate a lack of good investment opportunities or an unwillingness to take them. Therefore, we start our coverage by recommending a hold. Technogym's yellow may catch the eye, but all that glitters isn't gold.
Just had a question about, you had one of the slides in your DCF outlined a bull scenario. Is that based on different growth profile, or is that simply on valuation, or can you talk through that bull scenario?
Sure, let me clarify that one. So regarding the bull scenario, what we did was more of a qualitative analysis first, just to see how the spread of Technogym, what it can reach, what it can accomplish. So we understand there is a lot of potential to the company. In our bull scenario, actually, we project additionally to an increase in the digital strategy and an increase in the geographical penetration. The highlight would be the brand consolidation as a luxury brand. As we mentioned, currently we understand Technogym is more of a gray area, so not specifically, not literally a luxury brand. However, if in the best case scenario it does achieve to create, if you allow me the term, a blue ocean, because currently we understand there's no such thing as luxury fitness. If it creates this blue ocean and establishes itself as a luxury peer, we see a huge upside. In our Monte Carlo simulation, also, Albi, if you could go to the slide, please. In our Monte Carlo simulation, we try to show graphically how this would transpire. You can see that although the upside is much higher for the bull scenario, the distribution is much more thin. So it's much more unlikely that they will manage to reach this point, as opposed to the bear scenario, which would be, amongst other things, they're losing this premium appeal.
Well, regarding on the ownership of the company, even though the major stakeholder has 34% of the stocks, he has the 51% almost voting rights. So has this been or could be a threat for minor shareholders in history? Can you elaborate on the governance of the company, please?
Yeah, sure. Actually, the main shareholder, Mr. Alessandri, has structured its board of directors in a way which is not so, for which we are really skeptical about. As a matter of fact, his influence on the board of directors is really strong, as it nominates 10 out of 11 directors, and many of the directors are family related, or have been nominated according to his personal relationship with them. Also, if we focus on the ownership structure of the company, it's quite crucial to understand the fact that, yes, the ownership structure shifted from 60% of Mr. Alessandri in 2016 to a 33% nowadays, but he never reduced his voting rights. Actually, he enjoys double voting rights, and moreover, he has established in the last year a clear succession plan for which he wants his daughter, which is in the board of directors, to succeed. So in case he leaves the company, his daughter will be the new CEO of Technogym.
Yeah, and building up on this, he mentioned a divestiture of the owner from the company. As from 2017, he divested 4 times from the company, as you can see on this plot, which is the stock price and the full divestiture, and bring his participation in the company from more than 50% of the total shares to less than 35%. Despite this, as we know, the more than 50% of the voting rights are still in his hands. Therefore, we believe that the market is also kind of losing trust in his figure and penalizing his divestiture for the company. As in the last 3 times he divested, the stock price was negatively affected.
And it's important to stress the fact that the problems connected with Tenere Alessandri are not only governance problem, but are business problem, because all in the company, all the strategy is decided by Tenere Alessandri. So all the problems that we have with the challenging geographical expansion and with the no-riding of digital trends are a matter of the strategy decided by Tenere Alessandri. He has a strong influence of the top management and on the strategy.
Hi. You have a 6% downside to your target price. Why is the stock not a sell?
Okay, perfect. Let me clarify that for you. So yes, indeed, the company is facing a few challenges with regards to the trends and of the industry. However, from a financial analysis, we can see that the company is extremely solid. So it has a best-in-class margins, 19% EBITDA margins. It has positive net free cash flow generation. It has a 200 million cash position. So from the fundamentals, it's very solid. And also from a market analysis, its current multiple, specifically the P on E, is trading very close to the lower bound. So it's very hard for us to position a sell in such a strong company.
And just a quick add-on on this, it's worth mentioning that although Mr. Alessandri may have red flags from the governance perspective, through his personal networking over the years, he has been able to foster a luxury positioning of the company, and therefore Technogym has been able to achieve the best marginality in his industry, and is striving to achieve a luxury positioning. So therefore, although there may be some negative sides, we still see also positive sides, so it's like a counterbalance.
Just elaborating on her question, recently we have on a new scenario that we haven't seen in many years, which are positive interest rates. So the opportunity cost of not having bonds versus holding the stock is an issue. I don't know if you consider this, because it's not only the 6% downside of the stock, but also the money that you are not earning by being in a risk-free rate investment.
Perfect. So developing on what you mentioned, actually the company is losing a few amount of opportunities here. Currently, if you analyze its capital structure, we have a 10.4 WACC and a 10.8 cost of equity. So there's pretty much no debt that the company is using. Mr. Alessandri really prefers to finance the company through equity. It has currently a 0.3 debt to equity ratio. And actually, we performed a series of WACC optimization scenarios in which the company could indeed try to optimize the enterprise value. Of course, this is a highly empirical scenario. So we prefer to use a range to which the median would be about a 10 times as high leverage ratio for the company to increase its WACC, to increase its enterprise value.
And however, about the cash usage of the company, because you have spoken about the cash usage of the company, we see two big growth opportunities in the market that the company is not riding. And the first one is the digital trend of the industry, the hybrid fitness trend. So the company could invest in order to align its high-end product offer to the high-end digital offer. And the second thing is to build a network of flagship also in North America in order to be perceived Technogym as a luxury brand also in North America. Because now Europe, the founder, Alessandri, has been able to make a partnership with a luxury brand and to build all a network of flagship in order to Technogym to be perceived as a luxury brand. But in North America, we don't have this. So these are growth opportunities that isn't exploited by the company.
So I like how you've separated out the two main markets that the company operates in, the high-end hybrid fitness versus the traditional gyms. What would you say is the company's strategic advantage or competitive advantage in the hybrid industry?
Actually, we have some concerns in the hybrid industry for the company, because the company in 2021 has launched an app. There is a Technogym app that has more or less the same functionalities of the one of Peloton or Fit, so all the more digital players. But the problem is on the governance, because the top management consider the digital as ancillary to the strategy. Okay, so it's not a matter of the quality of the app, but about the focus of the management on that specific trend.
And just to give you a proof of how the management believes the hybrid fitness trend is ancillary, the digital trend is ancillary with respect to the company, is the fact that in 2016, the company acquired Exerp SPA, which is a software company, in order to enhance its digital strategy, but divested from it in 2021. So therefore, Technogym has not been able to integrate properly the software company, and so it didn't enhance its digital strategy.
And just to wrap up on the question, actually we do not see any advantage on the hybrid. So just to make that clear, and this is a huge concern. Just to give you some numbers, the CAGR expected for the fitness equipment market is 3.5, and the hybrid fitness trends are growing at a 14% CAGR. So the growth is clearly coming from the digital, and Technogym is losing this opportunity.
So I really appreciate how you went through the analysis of what competitors are doing and where they're investing that makes that differentiation. Have you seen this start to play through for Technogym's either current contracts or customers? I know you just had the revenues up, but are you actually seeing any other clients move or go yet?
Sorry, have you asked if there are some customers of Technogym going to some competitors, right?
Correct, who have made those other investments.
Okay. For now, this is not happening. So there are not big customers that are leaving Technogym. But if the hybrid fitness will grow as expected, or also higher than expected, we see some more digital players such as Peloton or Refit to exploit their strength in B2C to exploit a B2C2B, and so steal some customers also on the B2B side of Technogym.
And it's worth mentioning also the fact that the most critical metric to understand Technogyms are revenues. And in the presentation, we mentioned that the American players have indeed boosted their sales through the digital offer, and all the revenues that they have achieved over the past 3-4 years have all been stolen from Technogym. So therefore, it's like a loss of market share from Technogym. We cannot give you, for example, names about the customers because the company does not disclose any name of its customer in terms of revenues percentages. But still, we believe that in the North American market, especially, Technogym has been stolen of many customers and revenues.
Building on this, in the United States market, the digital trend is not the only problem. As we have seen over the years, Technogym has tried to penetrate that market since 2008. We found an article on the New York Times in 2008 where the owner said that they already had 80 million euros of revenues from the United States regions. Today they have 100. So.
Well, I think we saw a good analysis on margins. And recently, in the last quarter, the company reported a very good evolution in sales, especially in the post-pandemic era. And I want to know if now that we are getting back to normal, the market is a little bit crowded. You show us that in Europe it is. But do we can see a downward trend in sales in the future because everybody has already bought their equipments?
Actually, if we look at the granularity of 2022 sales, we already see a decline in B2C revenues. So the boost that we had during the pandemic was more than a peak rather than a substantial and a structural change in the company. And most of the revenues came from a higher penetration in the Middle East and in the APAC region. Therefore, we believe that there are a lot of opportunities for what concerns the geographical expansion. However, for instance, in Europe, where the company has more than 50% of its revenues, the European market already shows signs of saturation. As in 2019, the company had 0% revenue growth in that region.
In relation to margins, what can you talk through their input costs and how much control they have over that, pricing power that they have?
In talking about margins, pricing power is a key element, and the kind of cost structure they have, of course, is another. Talking about pricing power, over the years they showed signs of a good pricing power, managing to increase the price of their products over the years higher than inflation, also in the recent times. Whereas if we look at margins from a cost perspective, most of the costs are related to raw material purchase, personal expenses, and they also have really low investments. Therefore, margins are boosted by these three features, and the company presents a strong pricing power against also its suppliers. By company disclosure, they told us that we read that over the years, they managed to increase the quantity they purchase from suppliers, keeping the total price paid at the same. However, in the slides here, you can see that in the last 7 years, the cost structure hasn't changed a lot. And for the future, we are not expecting it to further improve from now.
One more question from me. Given that it's quite clear they have a dominant market share in Europe, a good degree of pricing power, and also serve a very niche market segment. And in fact, if you look at the gross profit margins at high 60 percentage points, they kind of trade similar margins with luxury brands such as LVMH. Why shouldn't the stock trade as a luxury brand with additional upside from geographic expansion?
I will be happy to answer to you.
Good afternoon, honorable judges and committees. We are from Universitas Indonesia. Today, let us tell you the story of Indonesia's 7-Eleven, or our country's biggest convenience store, AMRT. We initiate a buy recommendation on AMRT stock based on DCF valuation at the target price of 3,000 rupiahs, representing a 20% potential upside. It is driven by our three main catalysts, which are the opportunity to exploit the growing and duopoly industry, its growth and expansion which propels higher revenue, and the widening net margin. Throughout the years, MRT has grown significantly as over 20,000 stores open across various regions in Indonesia. Overall, Indonesia's retail consists of general trade like warung, moms and pops, and traditional market, and also modern trade. Among numerous modern trade players in Indonesia, AMRT is the market leader along with its competitor, Indomart. AMRT has two main verticals, which are food and non-food. Differentiates its business and comes with a digital initiative, which is Alpha Gift. Moreover, AMRT has other notable revenue streams, such as fee-based income and franchisee store royalty. After knowing more about the business of this firm, some of you might still have doubt over the firm's stock. Thus, from now on, we'll provide you further clarification so that you can buy the stock with confidence.
First, MRT has the opportunity to exploit its growing and duopoly industry. We believe Indonesia to double its mini market size, allowing AMRT to have additional 20K stores in the future. This will be driven by, first, low mini market penetration, as Indonesia is far left behind compared to developed market. Second, mini market is able to reap other trade channel market share, especially general trade that currently contribute the most. This is visible as mini market is proven to be the best trade channel compared to others. Unlike supermarket and hypermarket, mini market is located in a more strategic location and offer lower price based on our channel check of 10 modern trade channels. In comparison with general trade, mini market is superior in their product quality, completeness, and hygiene. Also, we see general trade has a limited promotion capabilities, as 85% of them doesn't want to innovate their business. Additionally, the industry is in a duopoly landscape, with AMRT and Indomart contribute to more than 90% of the market. And we believe the duopoly to sustain, as the two big players yield significantly higher expansion compared to smaller players. Also, we project the duopoly to not kill each other in the future, as more disciplined expansion will take place. Both players have learned from the past that undisciplined expansion will only result in jeopardizing their balance sheet, as well as lowering their profitability. We believe MRT has a significant moat due to its duopoly landscape in a still long runway of the industry.
Now, capitalizing on industry's potential, two factors will provide AMRT with a solid top line. Constant 7 to 9% same-store sales growth, equipped with sustained outlet expansion, translating to a robust 15% revenue growth until 2027. AMRT's nature as staple retailer proves that it is shielded from one macroeconomic pressure, the high inflation environment. It has strong pricing power, allowing cost pass-through directly to end consumers. Within the last 10 years, AMRT can price in 3.8% premium compared to the Consumer Purchasing Index, setting a stable 7 to 9% SSSG forecast, comparable to 3% CPI projections. It is 2023, and Indonesia is entering the pre-election year. With this election being the biggest, we forecast a massive threefold increase on the campaign fund expenditure that will be disbursed into lower income class as AMRT main target segment. Additionally, the increase in consumer class with urbanization trend yields strong structural growth that will remain beyond election period. this will provide room for growth as Indonesia still exhibits low GDP per capita and considerably very small basket size for staple, implying any increase in purchasing power will still push a higher basket amount for staple. Now, from the expansion side, AMRT has definitely learned a lot from its past. It was highly leveraged, pressured by its debt-funded expansion. But from 2018 onward, AMRT has leveraged by 48%, making its capital structure the most efficient out of all modern trade players in Indonesia. This condition enabled AMRT to capture mini-market growth potential shown by its also F2 capex to reach 5.5 times, rationalizing 25,000 total stores by 2027. Besides organic growth, 23% of total stores are being franchised to its partner, being the one-stop solution for efficient expansion, as it can provide 24% capex efficiency. And we see that AMRT's franchising will sustain in the upcoming years as they provide attractive yield of 10.3% 5-year IRR based on our interview with 7 AMRT franchisees.
Moving on, our third thesis is AMRT is currently at its beginning of net margin expansion. We expect AMRT to enjoy 210 bps net margin expansion until 2027, supported by 3 key factors. The first point is stronger bargaining and pricing power. Second is ex-Java expansion and operation efficiency. And lastly, tailwinds for fee-based income. The first point is achievable through leverage of AMRT's wide store network. As of 9 months 2022, AMRT accounts for 47% of Indonesia's modern trade outlets. With this number and upcoming store expansion, AMRT could establish itself as supplier's leading retail distribution channel, exercising higher bargaining power. In addition, AMRT could also maintain closer proximity to residentials, strengthening its pricing power to end consumers. For those reasons, AMRT's GPM should see constant expansion unlike other Indonesian retailers. The second point is pursuit of ex-Java expansion coupled with efficiency effort. Ex-Java expansion offers highest GDP growth complemented with lowest average wage growth, which in our view has been AMRT's ultimate factor of OPM expansion due to ex-Java's increasing store blend. Internally, we see AMRT is pursuing operation efficiency by decreasing its employees per store. We believe this trend should continue at slower pace. Externally, this pre-election year has the lowest wage growth, coupled with ministerial decree that capped annual wage growth at 10%. Hence, expect no high double-digit growth should repeat in upcoming years. Lastly, we presume fee-based income to reach 1.2% revenue by 2027. This is mainly driven by AMRT's wide product offering of fee-based transactions. We also surveyed 300 respondents, in which the majority had conducted fee-based transactions with AMRT. With our respondents mainly based in Java, we believe there is still an untapped market of ex-Java. Accounting all the catalysts, we derive a DCF-based target price of 3,000 rupiah per share, implying 20% upside from our valuation date. With 5 key drivers at the basis of our valuation, even a bear scenarios would only change our recommendation to hold. We ensure all of our key theses have direct correlation to our financials, hence impacting our DCF valuation through stable terminal growth, leveraged free cash flow, and higher pre-discounted free cash flow. Our weighted average cost of capital is mainly derived from its cost of equity, knowing that cost of debt is relatively insignificant due to MRT's minimum gearing condition. Our long-term growth is induced from Indonesia's inflation outlook, MRT's resilient business model, and consistent annual outlet opening. Furthermore, we conducted sanity check through peer relative valuation. We created 5 criteria in selecting our peers, mainly on their business models, company size, and operation environment. Our sanity check further confirms our valuation even better, presenting more premium. Also, 3 positive momentums should unhedge our valuation. First, being AMRT's resilient business nature in midst of macroeconomic volatility, making AMRT as Indonesia's primary retail proxy. And lastly, net cash position in hawkish macro environment. Our stress test also yields limited downside with respect to our valuation assumption, sales and wage growth, plus AMRT's balance sheet position.
Next, we identify several downside risks. First, the increase of minimum wage and rental price. We recommend to boost their efficiency by reducing the number of employees per store. AMRT also can negotiate a long-term lease with the landlord. Our target price is also sensitive to the risk of government regulation, which some of the local government prohibits further store opening. However, AMRT could maximize their store opening in the region that does not impose this restriction. Moving on to ESG analysis, AMRT stepped ahead of its competitor. We use the MSCI ESG framework and ASEAN Government Scorecard. First, IMRT is the only customer product retailer to implement solar power plant and EV charging station in their branches. Second, our channel check with 10 IMRT employees also revealed there are no layoff and no remuneration deduction during the COVID-19 pandemics at their outlets. Third, the election of Mr. Anggara Hans Prawira as the president director has eliminated the perception of IMRT as a family company. Weighing the impact on the valuation, IMRT, we found that IDX ESG start companies receive higher valuation from the market. Thus, IMRT is poised to benefit from its effort in enhancing ESG. Without a doubt, IMRT has a significant advantage due to its opportunity to exploit the growing and duopoly industry, superior growth and expansion that propel high revenue and widening net margin. We, Fortuna Capital from Universitas Indonesia, we are iterating our buy call to IMRT with a target price of 3,000 rupiah, translating to 20% upside. This is IMRT, Indonesia top-notch retail proxy in the making. Thank you.
Well, in 1 year, the stock price has almost doubled. And some ratios look quite expensive, especially price to earnings, price to book, almost 10 times on the last one. I don't know if all the good news you are projecting are already in the price or not, especially if we see a higher interest rate environment. Could you tell us about that?
Okay, let me elaborate on that, sir. So, here we compiled our trading comps and multiples valuation. As you can see, we select peers from Asia market, which is the developing and developed market as well. You can see on the bottom line of the picture that AMRT in terms of multiple of price to earnings growth, EV EBITDA, EV sales, and gross profit are all in discount compared to regional peers. This is why we believe AMRT still has a room for growth moving forward, that the thesis is not still priced in on the local market, because you know, AMRT is the primary retail proxy that does not no company has any chance to beat it in a local, the public company. So they receive higher premium for that. But if you compare it to the regional, they're still lagging behind on the terms of multiples. I hope that answers the question.
Yes.
Would you mind talking a bit about just ESG, any environmental, social, governance components that may have influenced your or not influenced your recommendation?
Sorry, can you rephrase the question?
Talk a bit about ESG relative to the company and if it had any impact on your recommendation.
Thank you for the question. Can we go to the ESG appendix?
Right.
Number environmental and ESG analysis. The next. The previous one. So we identify some key issue evidence based on MSCI ESG framework. So can you go? So basically, the environmental one, we use the key issue of carbon emission and product carbon footprint. So we assess the IMRT performance on this. Next. And for the social one, we use the labor management and product safety and quality. Next. And we also assess the privacy and data security and community relation for the social one. Next. And for the governance, we use the ASEAN Government Scorecard, and we found that the management already have a good governance because IMRT is a family company, but currently IMRT is, the president director of IMRT is the independent director. So we believe that the governance side is more independent despite it's a family company. I hope it's can answer the question.
Yes, and if I might add, if you could go back to the appendix list and go to the cash flow related to the financial valuation, number 3, and go to 3B. In terms of dividend payment, we see that currently the current dividend payout ratio is at 51%, and it is already aligned with the current regulations that the government that the AMRT have set previously, in which they set at minimum 40% of dividend payout ratio. So we see that by implementing the straight line of 51% based on the data and numbers that we got from the 2021 data of 51% of dividend payout ratio, we see that AMRT is able to pay like all obligations in terms of dividend to all of their shareholders. And also knowing that they have currently a stronger bottom line going forward, we see that the dividend yield and dividend per share will grow in upcoming years. Yeah, hope that answers your question.
Hi. In Indonesia, I think cash transactions typically make up bulk of purchases. How immune would they be to competition from the likes of e-wallets and digital apps?
Okay, I'll be addressing the question. So, in terms of penetration of digital and e-wallets, AMRT is collaborating with digital banks, which targeted a Sharia and low-income segment from the society in Indonesia, which means that they are penetrating higher market share, higher market base in terms of digitalization and a product offering. Basically, this helps them to secure the digital transaction part of the society in Indonesia. I hope that answers the question.
Thank you.
You have a lot of positivity there about the future expansion of margins. What do you think are the key risks to your thesis there, and how could it go wrong on the margin side in particular?
Thank you for the questions. I'll go to the stress test to give a clear explanation on that. So you can see on the bottom picture, our top two most affecting factors is sales growth and wage growth. In terms of wage growth, as I explained before, they are capped at 10%. So you can see at this level, they should be fluctuating behind that. And in terms of sales growth, first quarter 2023 earnings just came out last night, and it happens to outperform our valuation, our financials, I mean. And I hope it underbolts the statement that they are capable of outperforming our thesis even more. So yeah, we're being conservative on the ticker. I hope that answers the question.
So I noticed in your slides, you've separated Jakarta and ex-Jakarta in your growth projections. Could you expand upon why you chose to look at those two regions independently of one another?
Okay. In terms of expansion, I'll go here. Why we decided to separate the Jakarta, the ex-Java, and the Java region, because we see that Jakarta is full of competition, whereas like other mini market from foreign is like penetrating the market as well. Hence, the margin is very thin given the business model of the mini market. And as you can see, ex-Java is really underpenetrated. So they boosted their blends by threefold in 10 years. And also the sales mix is also like sixfold in the past 10 years. And we're dividing that because we believe that the ex-Java will be the primary growth driver moving forward. And this chart is also interesting that the EBIT margin in ex-Java sixfold in the past 10 years, while the EBIT margin in Jakarta like half in this 10 years, which shows that Jakarta is really saturated market. Hence why we divided it into Jakarta and ex-Java. Hope that answers the question.
Thank you.
You talked, I think in Indonesia, the mini market scene is pretty much a duopoly. What's stopping the key competitor from replicating this success?
Thank you. I think we should go to the duopoly dynamics number 23. Yeah, basically from the duopoly side, there has been fighting since the 2000 decade, and they are the oldest player in the mini market from Indonesia. And we believe the status of the first mover advantage from these two players yields result in their significant moat that no other competitor, basically foreign competitor, can enter the market. And we believe the market knowledge has been accumulated for the last 30 years, and this kind of market knowledge that doesn't have by the foreign company to enter the Indonesia is making them failure in Indonesia. For example, 7-Eleven in 2017, they exit the market. And currently, Gerald, can we go to the appendix of diperlook in the mini market, I think it would be in the 17. As you can see in the bottom left-hand side, you can see several foreign players, for example, Family Mart, Circle K, and also Lawson. But for Circle K itself, for the last 5 years, there has been closing like 10 stores in Indonesia, and for the Family Mart, they're expanding a little, like 10 stores per year compared to Alfamart that averagely 1,000 per year. And currently, Lawson is the most growing foreign player. For example, they grow like 36 stores per year, and currently Lawson is under of Alfamart, and we believe Lawson can do something like this because they are under Alfamart and can harness the market knowledge of AMRT itself. I hope that answered your question.
Yeah, if I might add, can we please go to appendix number 14 about brand positioning? So AMRT is currently have a strong brand positioning compared to its competitor, number 14. Compared to its competitor, as we can see here, AMRT has Alpha Midi, which focuses to provide fresh products, Dandan, which provide healthcare products, and Lawson, which provides ready-to-eat and ready-to-drink products. So they have a strong brand positioning, which its competitor doesn't have any. I hope it answers your question. Thank you.
Well, the company is facing a significant future expansion from 40,000 stores to 80,000 stores. And they are not using debt in this expansion, which if the market is eager to have the double of stores that they already has, it seems like straightforward to finance this expansion with debt and lower not only the WACC but unlock value of the valuation of the company. Why do you think this is not happening?
Thank you, sir. Gerald, can we go to the main slide for the, I think, to our thesis in the next. Yeah. I think I would like to answer first on the perspective of the expansion first. We believe moving forward, the duopoly of the AMRT and Indomart will not aggressively expand because they are now have learned from the past that aggressive expansion will lower their balance sheet and lower their profitability. And because of that, we forecast an expansion that is would be more disciplined. That would be not using any debt like that. And I believe based on our study case, can we go to the appendix? Okay. Yeah, based on our study case of the China and also US, they are also expanding slowly. Yeah, based on this chart, the line chart is expanding like they're not aggressively expand in terms of their number of mini market, and thus we also forecast discipline expansion based on these two main players. And I think my friend would like to add about the net debt expansion.
Yes, if I might add, if we could go to appendix number, yes, the debt condition summary. So actually, currently, AMRT is already debt-free by 2021. So all debt are already being repaid. And still, currently, AMRT is able to pursue a massive expansion of 1,500 stores to 1,800 stores per year. It equals to 3 to 4 store openings per day. And they still able to do that with them being debt-free currently. And if we could go back to the appendix list and go to the franchising operations. So this is one special side about AMRT because they can expand using one of their method called the franchising operations. Basically, they could then receive the capital expenditure from the franchisees to then open the store based on the same format that they have already stated previously. So by having these franchising operations, they could attain 24% capex efficiency. So with the current very stable and also spacious balance sheet, they are very capable of doing the expansion going forward. Hope that answers your question.
It was great to hear about the interviews that you did with franchisees. How did that change your outlook or impact your valuation?
Sorry, can you rephrase the question?
You interviewed franchisees and met them. Did that change your valuation and how your perception of the company?
I think our interview changes the perspective that how Indonesia is appreciating AMRT franchise operation excellence because they are declining slightly because in terms of total stores. But however, we expect it to pick up given that AMRT is currently more promoting more about the franchising operation that yields more attractive yield compared to government bonds. Even if we incur risk, it is is this slightly secluded because AMRT has retail operational excellence proven in 30 years of operation. So yeah, we expect the franchise to pick up number and AMRT to have more capex efficiency going forward. Thank you.
Well, the company has named a new president of the board, but it's still a family business. 53% of the shares are owned by the family. And despite they have named a new president of the board, I want to see your insights about the risk for minor shareholders because of the governance of the company.
Okay, thank you for the question. Can you go to the appendix list and the BOD and BOD? So basically, the BOD overview, the family member of BOD is only one. So, and the president director is independent director. We believe that the number of this family member is relatively low, and for the board of commissioner is only 2 out of 4. So we believe that the composition is still good. Thank you.
Thank you, judges.
Thank you, judges.
Qantas, Australia's enduring flagship carrier, has emerged from turbulence a structurally better airline with further runway to drive upsized shareholder returns. We issue a buy recommendation with a 12-month price target of $7.76, an 18.3% premium on the 1-month volume-weighted average price.
Qantas Group is Australia's travel provider of choice, with its namesake full-service carrier and its low-cost carrier subsidiary Jetstar being the only Australian airlines with long-haul international flights. Qantas is the 3rd oldest operational airline in the world and is renowned for its safety and quality, having never crashed an airliner. It dominates on the world's 5th busiest route between Sydney and Melbourne, which form the golden triangle of travel with Brisbane. Having emerged from turbulence, aviation is soaring. Travel demand continues to recover to pre-COVID levels as people prioritize travel over other areas of spending. Qantas is well positioned to capture much of this demand, with their dual segment targeting of full service and low-cost travelers, allowing them to exert a stronghold on both ends of the market. In a quasi-monopolistic structure, Qantas holds a dominant 62% share, double the next competitors. Despite emerging from COVID a structurally better business, Qantas still flies below peers. We believe the market fails to recognize the attractiveness of this business, as Qantas's discount to global peers is 1.9 standard deviations below the pre-COVID average. Therefore, we issue a buy recommendation with a target price of $7.76, representing an 18.3% upside based on 1. Qantas's domestic market advantage, 2. Qantas's profitability from cost discipline and accretive capex, and 3. The reduced cash flow risk from revenue diversification.
Qantas's unique domestic market advantage has flown under the radar. Qantas's domestic market possesses unique structural advantages which make it the most attractive aviation market in the world. On the left, Australia's dispersed population and lack of high-speed rail network make it difficult to avoid the skies, resulting in a uniquely inelastic demand for air travel. On the right, Qantas's market position is uniquely concentrated, allowing it to operate a quasi-monopoly. There is no airline industry in the world like this. The potent combination of dominant market share and an inelastic end market imply pricing power. This will allow Qantas to sustain yields without demand destruction, delivering industry-leading margin performance. Despite these strong structural advantages, Qantas's discount to global peers has widened. This illustrates a clear current mispricing of the business. Despite these sort of on the right, Virgin, Qantas's key competitor, is currently running an international IPO roadshow. This will drive investor awareness of the structural advantages of Australian aviation, aforementioned, providing strong exposure to the market leader, Qantas. As such, it is now the time to buy, before strong international interest catalyses a re-rating of the business.
Qantas has emerged from COVID with stronger earnings power from a renewed cost base and margin accretive capex. Qantas is now a fundamentally more agile and cost-efficient airline. In a disciplined market, Qantas has flexibility to adjust capacity and preserve profitability. Its main competitor, Virgin, is unlikely to irrationally expand capacity as intentions to IPO requires a track record of profit. Qantas has also materially reduced its fixed costs. We forecast that the structural cost reduction recovery plan combines with the inflation offsetting transformation playbook to deliver $828 million of cost saving post-inflation. Despite this, the market has underappreciated Qantas's profitability. Consensus operating margin estimates remain below management targets and revert to historical averages, despite how post-COVID Qantas is now a fundamentally better business with a renewed cost profile. Domestic fleet renewal project Winton will further generate margin uplift. Qantas is better placed than peers to undertake fleet renewal with the lowest net debt to EBITDA ratio compared to peers with similar fleet ages. The new Airbus narrowbodies will boost unit metrics. The greater capacity per plane allows Qantas to maximise the usage of Sydney Airport slots. An increased range drives aircraft utilisation with high fuel efficiency, further contributing to unit cost reduction. Overall, we estimate that the project will deliver a 12% unit cost benefit and 4% unit revenue uplift.
Thirdly, Qantas is more than just an airline. Its diversified, resilient portfolio will reduce cash flow risk in all market conditions. Freight is an underestimated element of Qantas's business. As Australia catches up to the peers in online shopping frequency, Qantas is best positioned for strengthened e-commerce uptake as the domestic freight market leader, capturing 3.9% more market share by FY28. We see this supported by an exclusive Australia Post contract renewal and a unique Amazon aircraft arrangement. Even greater revenue uplift is derived through its high-value Southeast Asian and US freight network, which could increase share price by a further 3%. Thus, we have strong conviction that Qantas's reinvigorated freight mix is now the new normal. These e-commerce tailwinds will bolster Qantas's world-class loyalty program to help stabilise EBIT. This best-in-class program is the only segment that remains consistently EBIT positive. So this, together with freight, will allow Qantas to weather all storms. Qantas's beta sits at 1.36, well below the global pure-play airline average of 1.55, an indicator of Qantas's durable diversification. Qantas is building its brand beyond the balance sheet through a strong ESG focus. Qantas is becoming a mover and shaker with its growing green mindset. It is the first and only domestic airline to 1. Tie its short-term executive remuneration to decarbonisation targets, and 2. Begins establishing a sustainable aviation fuel industry in Australia, seeing its jet fuel efficiency increase 1.5% annually, superior to its peers. Qantas too has emerged from operational turbulence well ahead of expectations, in fact improving upon pre-COVID flight cancellation levels. Thus, Qantas is rejuvenating its reputation as Australia's trusted and reliable airline, supported by a diverse team and a strong governance pipeline. Thus, we believe that Qantas's ongoing focus on ESG will be rewarded in an environment that prioritises sustainable investing.
Soaring with a margin of safety. We valued Qantas using a blended approach consisting of a granular, bottoms-up discounted cash flow model weighted at 70% and a relative valuation at 30%. This arrived at a share price target of $7.76. Our DCF was driven by segment-specific value drivers, whilst our relative valuation applied a proprietary historical premium and discount analysis on 3 distinct geographic peer sets. In acknowledging risks, we sensitize yields, load factors, casks, and loyalty points in a bear case, which resulted in a 7.2% downside. We even conducted a Monte Carlo simulation that showed that our buy recommendation holds in over 80% of situations. Evidently, this supports a risk distribution that's asymmetrically skewed towards the upside and hence strengthens our buy recommendation. We considered two further downside risks to Qantas. Firstly, elevated refining margins threaten profitability as Qantas hedges Brent rather than jet fuel due to illiquidity in forward markets. However, we believe Qantas has multiple operational and fuel efficiency levers available to mitigate this impact. Secondly, a macroeconomic downturn could negatively impact Qantas in the Australian market. We believe they are uniquely positioned to navigate this through, one, their exposure to fly-in, fly-out corporate and government clients who are more inelastic. Secondly, they are naturally hedged in capturing downsizing travellers through their low-cost offering in Jetstar. And thirdly, net migration in Australia is expected to rebound above pre-COVID levels as workers and students come back to the Australian economy, which will act as a structural growth driver. We have also applied our assumptions conservatively across our valuation to create a margin of safety in our buy recommendation.
Ladies and gentlemen, Warren Buffett said he'd never invest in an airline. But today, we argue that he would invest in a business that, one, operates a quasi-monopoly in a structurally advantaged market, that two, has emerged from COVID with a renewed cost profile and greater earnings power, and three, has diversified and de-risked more than any pure-play airline. And that business is none other than Qantas. Thank you.
Despite the positives you put through, the stock continues to trade at a discount to regional peers. Do you think the discount is actually due to them only operating in one market and given limited by the size of the market?
I'm happy to take that one. So if we just move to slide H4, 132, which illustrates the premium versus the comparable sets. Ultimately, this business has traded at a premium to European peers and a discount to North American and Asia Pacific peers. We believe that this discount is really coming from, one, specific sort of differences in average multiples across exchanges. For example, the Australian tech market trades at a premium. And then two, ultimately, it also accounts for this geographic concentration. But however, we believe that the structural improvements that this business has been able to undertake, their dominance in market share, their renewed cost profile, and their de-risking has made this business's fair multiple trade closer to where narrow the discount to North American and Asia Pacific peers. So ultimately, it is really about where it trades relatively, and we believe that it's trading lower than it should.
Yeah, I'll ask a follow-up question on that point, because it seems like a key point of your investment thesis is it's undervalued, underappreciated. Do you have views on what would it take for the market to recognize its market value, and what could bring it in line with some of the peers?
Yeah, absolutely. So if we turn to, please, slide 25. Now, ultimately, we believe our catalyst will be continued favourable financial reporting. So a key catalyst will be Qantas's full-year results in August this year. We also feel that buybacks, continued buybacks, acquisitions will also sort of drive this favourable narrative. But if we also turn to slide K8, just on the appendix, we believe that a key centrepiece for this catalyst is Qantas's IPO roadshow. So a key sort of gap missing from the current market perspective is really a lack of understanding about the structural advantages of the Australian market. The international roadshow will drive this investor education, delivering ultimately a greater awareness of the attractiveness of this market, really just catalysing a re-rate from strong international interest.
In relation to the IPO, why are Virgin raising capital, and will their use of that capital impact Qantas in future?
Virgin, it was, so just moving back to K8 or 153. So Virgin ultimately went bankrupt in 2020, which first speaks to the dominance of Qantas within this space. In terms of raising capital, they are relisting to gain exposure to that sort of listing environment. We don't believe that this sort of capital raise will drive too much sort of change in the competitive dynamics, because ultimately Virgin will keep a rational capacity setting, which means that they won't expand capacity to try and take market share. They did this through 2011 through to 2018, and they didn't turn a profit in any point in those years. So ultimately, Qantas is pretty safe in their dominance of this market.
The competition watchdog is expected to oppose the proposed acquisition of Alliance Aviation. Do you think this is going to be the case? And maybe they are not trading at the levels you are expecting because these kind of news are in the market and can affect the cash deployment of the company.
Yes, so happy to take this question. So we could please turn to slide 38. So we have seen that the ACCC, or the competitive regulator for Australia, is likely to block the acquisition of the remaining area of Alliance Aviation. But what we can see here is that they've already acquired a 20% or so interest, and we believe that our valuation is very much based on this, and we have not forecast any further kind of regaining of Alliance, mainly because we recognise that Alliance operates on very much kind of different routes to Qantas, and so as a result, it does not kind of impact their main business model on which we are modelling. It very much is going to Western Australia, which is in terms of our kind of mining and very much regional routes, not as opposed to Qantas's kind of main business model. So it has no material impact.
Well, for example, in Western Australia, they are going to slash fares in maybe 1 million seats. I read those news on Bloomberg. And you were presenting that demand is very inelastic. So how can you explain that if demand is so inelastic, they are going to slash fares in those many seats in the Western Australia routes?
So the Alliance, so we can just go back to that slide 38, please. So this Alliance Aviation, they operate on very different routes in terms of regional routes, which Qantas does not dominate on. And so those slashes are very much distinct from the model which we are currently operating on. Say, for example, Rex is one of those operators on those lines. And as we can see here, we have on the slide that we mentioned that we've taken into account that kind of competitive dynamic, which Qantas will likely not interfere with. And so that slash is not to do with anything about the inelastic demand, which is within the kind of Golden Triangle region, which we mentioned earlier, but that's very much separate to where Qantas kind of operates, distinct to their kind of corporate and fly-in, fly-out clients as well.
Just to add to my colleague's point, if you could please turn with me to page 117. The idea of slashing seats doesn't necessarily come down to regional factors specifically. It's also a lever that Qantas can pull to reduce their fuel efficiency, their fuel costs through fuel efficiency levers. So for example, on the right-hand side here, if I can draw your attention to point 2, Qantas are able to optimize their load factors, which is essentially the amount of planes that they put in the air, to ensure that the ones that they do put in the air maximize their usage. So what that means is from a given level of fuel expenses, we can maximize our yields from that. So in a elevated fuel cost environment, it's very important that Qantas has the ability and capability, as you mentioned, to be able to slash seats and optimize their margins and profitability for that. And as the market leader in a functional monopoly, as we've mentioned, Virgin, their largest competitor, is about to go on an IPO roadshow, and they did go bankrupt recently. This is a clear demonstration of their market power in which no other airline in the world can demonstrate without disrupting demand, ultimately.
Could you speak about Qantas's reliance on international freight and passenger travel, and if you took into account any potential geopolitical risk, especially in Southeast Asia?
Yeah, absolutely. Thank you very much for the question. If you can please turn with me to page 85 firstly. So the first thing we want to discuss is we conducted a granular bottoms-up revenue build to account for the specific risk factors that each segment are exposed to. So on freight specifically, if I can draw you to the second last row of this page, we looked at the price and volume impacts that explicitly affect the freight business, to your question. Now, diving into that deeper, if you turn with me to page 92, what we can see here is a couple of things. Firstly, on the left, we can see that our yields in the dotted line is forecasted to taper across our forecast period, having been elevated during COVID. On the right-hand side, we see that the CAGR that we assume across our forecast period, so the compound annual growth rate, is markedly lower than what it was pre-COVID. Now, this does a few things. One, it establishes a margin of safety in our recommendation. Two, it accounts for the fact that there are geopolitical risks that are playing out in the area at the moment. And three, and arguably most importantly, the idea that the world is about to potentially go through a recession. And so it's very important that we apply our forecasts conservatively to build a margin of safety in our recommendation and ensure that we account for those risks that are potentially around the corner. And by doing that, it strengthens our buy recommendation.
I found it quite interesting you have ESG as part of your thesis for the stock, but where do they rank versus regional and global peers?
Sorry, could you please repeat the question?
You have ESG as part of your thesis. Where does the company rank with regards to regional and global airlines?
Yes, so if we could please turn to slide 160, please. So in terms of the MSCI rating for Qantas, we can see that it currently is rated average. And we do recognize that if you kind of break this down, it means that you can break it into kind of environmental, social governance factors. So if we could please turn to slide 74, I believe it is. The kind of key area where Qantas does lead is in its governance, but it does lag behind a bit in its social aspect. But we do believe that this has been due to kind of one key issue, and that was previously last year on-time performance for Qantas, and which was quite blown over by the media as well. So just going to the next slide, please, we can see that Qantas has in fact started to improve on this. They have their on-time performance improve, in fact, above pre-COVID levels at 81.5%. And so we see that even though this ranking currently might sit more average or in terms of that, and we see that there is much runway for Qantas to improve as well.
With respect to your valuation, notice you used a 70-30 split between DCF and relative value. Just can you talk about how you arrived there? I know part of your point is relative to competitors, so how did you come to the 70-30 split?
Happy to take this one. Thanks very much, Andre. So we ultimately utilize this blended valuation methodology with a tilt more towards intrinsic valuation. This was to explicitly account for the Qantas specific drivers of value, its dominant market share, its elevated operating leverage, and its fixed cost reduction program, but also to account for broader market volatility and uncertainty across multiples. We did, however, tilt 30% towards a relative valuation approach, really just to account for uncertainty in our forward assumptions, but also to bake in a margin of safety by conservatively assuming that this business's fair multiple hasn't improved relative to where it was sitting pre-COVID. I think we've spoken a lot about how this business has structurally improved, really just conservatively baking in margin of safety there.
You mentioned about as a serious factor, the retirement of Alan Joyce. Why do you think is a risk factor? Are you expecting an outsider from the company to come in, or is there a succession plan within the company so the strategy can prevail?
Yes, for sure. So yes, we do acknowledge that Alan Joyce is leaving the company after 15 years, but they've currently most recently named Vanessa Hudson, and we see three key reasons why this will be very effective for Qantas. So first of all, Qantas has a history and a track record of successful in-house promotions. We see that. Secondly, the current CEO, Alan Joyce, was actually the CEO of Jetstar, the subsidiary, for 5 years prior to being promoted. And so now thirdly, that Vanessa is the incoming CEO. She's currently the CFO. And we see that this has laid out the groundwork for her for several years, and she has very sufficient time and runway to step into this position. And most importantly, Vanessa as CFO, has actually led multiple initiatives. So if we could please turn to slide 24, we can see that Vanessa Hudson, in her time as CFO, has actually led, first of all, the bolstering of Qantas's market share. She was the one who, secondly, led the cost out program and the unit profitability that's improved. And thirdly, she's very much across the loyalty business. So we see that this succession plan is very much one that is intact and one that will be very successful, alike Qantas's history.
Do you think that they will lose some pricing power with the move to more freight and, you know, working with companies like Amazon? Are they going to struggle with pricing power on that part of the business?
Yes, so happy to take this question. If we could please turn to slide 63. So what we're seeing in the freight kind of industry is that the Amazon aircraft arrangement is very much something that will bolster Qantas's business as opposed to take away its pricing power, because Amazon is a key driver of the kind of business that flows through Qantas and the freight converted aircraft that they have. And given that Qantas is the market leader in Australia, they have 20% market share, the next competitor is about 12%, and we see that they are the main company that will drive freight throughout Australia. And so any kind of business to consumer B2C deliveries will be very much centered around Qantas.
I don't know, we're nearly up on time. I think everybody thinks we're nearly up on time.
I'll go ahead and ask a question. Airlines, price of oil, maybe talk a little bit about risks that it might face.
Happy to answer this. If we can jump to 136. So we have conducted a sensitivity analysis between the price of crude oil.
We recommend a buy for Chipotle with a price target of $2,400, providing a 15% upside. Chipotle's innovative combination of an assembly line service model and high-quality ingredients creates unparalleled value. With its effectively executed operating model, Chipotle has all the ingredients for success. Chipotle offers the best value proposition in the fast casual industry, providing a 20% price gap to peers. Customers love Chipotle's value proposition, and the ability to sustain this at scale gives Chipotle a strong competitive advantage. With a large lead over its peers, we expect Chipotle to easily double domestic store count up to 7,200 stores, while also having a long runway for growth in untapped international markets. The substantial throughput from this expansion will only strengthen unit economics, and new technology will accelerate profitability. Supported by its improving ESG initiatives, Chipotle's growth will be fast and organic, as its accelerating free cash flow supports self-funded expansion while also having excess cash to return to shareholders.
Chipotle pioneered the fast casual concept in the 90s and remains the market leader today. Its efficient business model, menu design, and store layout provide operational advantages that keep costs low and create the strongest value proposition in the fast casual segment. To quantify this value proposition, we identified 7 fast casual peers who offer entrees at similar price points to Chipotle's standard chicken burrito. Across the top 5 cities for each brand, we found the average price of a standard entree and compared it to Chipotle. And we found that without sacrificing quality, the average Chipotle entree is up to 20% cheaper than average entrees from competitors. This wide price gap gives Chipotle significant optionality against peers. It can increase prices to expand its margins further or maintain its discount to peers and continue taking market share. The fact that Chipotle has been able to maintain and even expand this value proposition through explosive growth is a testament to its strong execution. This is due to Chipotle's fully corporate-owned store model, which reduces operational risks, combined with a debt-free balance sheet. While Chipotle's operating leases are similar to debt, they are not reliant on capital markets, and we expect Chipotle's value proposition to make it a preferred tenant with landlords. Chipotle's price gap and operational advantages have been a historical magnet for throughput, resulting in our forecasted same-store sales growth of 5.6% annually through 2032. Based on its wide price gap, we expect Chipotle to maintain pricing power as it sustain high transaction growth as it grows store count in its large domestic market.
Chipotle currently operates over 3,000 stores in North America, and our analysis shows that Chipotle has the potential to more than double its store count. To confirm this, we conducted our own independent store density analysis to find Chipotle's domestic tangible addressable market, or TAM, by looking at the top 30 cities in the United States where Chipotle achieved the highest densities of stores per person and applying that density to North American cities. Our analysis shows that Chipotle has the potential for more than 7,200 stores in North America. Chipotle still has massive domestic store growth potential, and they can realize this potential through their use of Chipotlanes, or Chipotle's mobile pickup windows. Stores with Chipotlanes have 15% higher AUV on average than traditional stores from increased digital throughput, and we believe that these Chipotlanes will help drive store growth domestically. We consequently forecast store count growth growing 11% annually before Chipotle begins to taper off as it reaches our 7,200 store count in 2032. Even after Chipotle expands domestically, there is still extreme room for them to grow in the international markets. We conducted the same TAM analysis with more conservative assumptions when looking at the top cities in Europe and Asia, where we believe that Chipotle could expand the easiest. Our analysis shows that Chipotle has the potential to expand into 2,600 stores in Europe and 3,200 stores in Asia. Quick service brands like McDonald's and Yum have seen significant success in adapting their menu items, and we believe that Chipotle's modular menu design will find similar success. By 2032, our forecast only incorporates 800 international stores. While we do not see Chipotle reaching the same size and scale as McDonald's or Yum, having just a fraction of their store base gives Chipotle the runway for sustained store growth.
Along with strong store expansion, Chipotle's unit economics allows for same-store sales to catalyze margin expansion, driving our forecasted 29% restaurant margins by 2032. With labor and occupancy costs largely fixed on the restaurant level, throughput will be a substantial contributor to margin expansion, and our historical analysis shows the potential for over 4% margin expansion through sales leverage alone. This will be bolstered by automation, as Chipotle is already investing in initiatives to increase efficiencies, ranging from Chipotlanes, mobile ordering, and food preparation automation. While these initiatives are still being tested, Chipotle's modular menu design, corporate-owned structure, and experience management should allow for seamless integration of these technologies throughout all stores. Even when factoring in increased marketing investments, which could contract margins, Chipotle has a clear path to 29% restaurant margins and 18% operating margins by 2032.
After independently ranking Chipotle's environmental, social, and governance practices, we see numerous initiatives that lower the business model risk, justifying its below-average cost of equity due to lower financial leverage. Environmentally, Chipotle's most impactful practice are their large investments in local farmers, which we believe will only enhance and prolong the sustainability of their supply chain. Socially, Chipotle emphasizes the clear career path available to employees and boasts a 90% internal promotion rate. While Chipotle has prioritized diversity on the restaurant level, they've yet to do so with their board. Currently, only a quarter of the board are women or minorities, and we see this as Chipotle's primary area that needs improvement. While third parties do rank Chipotle lower in governance due to board and management turnover, we see the addition of CEO Brian Niccol as beneficial due to his strong track record at Taco Bell and other Fortune 500 companies, as well as his successful turnaround of Chipotle's brand. Brian Niccol and the rest of the board are also well aligned with shareholder value creation, as their compensation is tied to 90% of variable performance elements.
Chipotle's strong and sustainable growth leads to substantial free cash flow generation. In our forecast, we utilized our 5.6% AUV and 8.7% store count annual growth rates to derive our forecasted 16% annual revenue growth. With strong store expansion, capital expenditures will accelerate, and we forecast them growing 15% annually through our forecasting period. And despite this growing scale, we still see restaurant margins reaching 29%, and operating margins reaching 18% due to sales leverage and automation. The result is free cash flow growing 18% annually through our forecasting period. With this substantial free cash flow generation, Chipotle has significant excess cash, which they can return to shareholders in the form of share buybacks and dividends. When we incorporate this into our earnings model, EPS grew 22% annually on top of our expectations that they can issue a dividend after 2027. With this cash flow generation, we derived our 2,400 price target, representing a 15% upside to the current price. For our valuation, we utilized a 10-year DCF and 8.4% weighted average cost of capital, which we believe incorporates Chipotle's lower risk business model due to their financial and operational strengths, as well as improving ESG. We then used the price to earnings exit multiple to calculate our terminal value to account for Chipotle's lasting growth internationally. And our multiple represents a 10% discount to peers that are currently growing internationally to account for the potential of lower penetration than this peer group. To confirm our DCF price target, we also compared it to multiple other relative valuation methodologies using the same 10% discount to peers. And the results confirm the significant upside that we see in Chipotle stock today. However, we do recognize that there are risks to this upside materializing. The primary one being Chipotle's already premium valuation to peers, as their price to earnings is double that of the industry average. However, because of Chipotle's strong growth and free cash flow generation, our forecast shows that they can quickly grow into this valuation over the next 5 years, making it a strong opportunity today.
Chipotle may also face challenges with its ambitious plans to both improve unit economics and double store count. Our sensitivity analysis of AUV growth, store growth, margins, and our exit multiple does show potential downside. However, we remain confident in Chipotle's continued value creation due to its lasting competitive advantage, and our TAM analysis shows a long runway for growth without interfering with current stores.
Finally, we recognize that international growth for Chipotle must be proven. When we incorporate this risk using the terminal growth method in our base case, we see a downside if growth cannot persist. Nonetheless, Chipotle's simple business formula is easily transferable outside of North America, and CEO Brian Nichols' prior experience at Taco Bell and other Fortune 500 companies should allow for franchising if needed. Franchising would both help reduce operational risks and provide long-term margin tailwinds, justifying our PE exit multiple method.
To conclude, Chipotle's simple business model sets them up to serve affordable, convenient, and high-quality products to their growing customer base domestically and internationally. With their debt-free balance sheet and corporate-owned strategy, Chipotle's growth runway is clear. And when combined with improving unit economics, the substantial free cash flow generation results in a 15% upside for investors today. Thank you for your time, and we now open the floor to questions.
Well, we saw the last week report an improvement in margins, which is very impressive after the price in food that we have experienced recently. Do you think there is still room to go on this margin improvement, and or these food prices increases could affect the positioning of Chipotle by trying to position themselves as a price quality story?
Yeah, I can start off there. Thank you for the question. Jerica, if you go to slide 5, please. So we definitely recognize that inflation and food input cost increases do affect the business, but they will affect the entire industry. So where Chipotle sees input costs increase, the rest of the industry will as well. And this can allow Chipotle, because of their 20% average discount, to increase their prices sometimes even faster than competitors and still remain cheap relative to their competition. In addition to that, input cost increases aren't consistent across the board, and we noted that in the most recent earnings report, they did say that the price for avocados had actually fallen, which caused a positive margin impact.
Yes, and then to answer your question with regards to how that impacts our margin expansion, we think that kind of confirms the fact that we see significant margin expansion through our long-term time period. And the main reason for that is because our margin bridge shows that a significant amount of the margin expansion is primarily through sales leverage instead of increasing prices. So we conducted this by doing a historical regression analysis to look at the impact of 1% of same-store sales on the overall effect on labor and occupancy costs being the largest fixed cost on the restaurant level. And that was the basis of our overall margin expansion. And now with the most recent quarter that we're seeing more sales leverage than we initially expected, we see potential for even faster margin expansion than we originally firstly thought.
Just looking at the Bloomberg average consensus target price, there doesn't appear to be much upside because average target price is around 2,000. But you have a 15% upside, and where do you differ with regards to how do your consensus estimates? Yeah.
Yeah, I can take that one as well. Jericho, if you could go to slide 4, please. So again, back on the price front, we believe that Chipotle occupies a unique space in the fast casual market where they are cheap relative to competitors and have been able to execute this at scale for decades. And when you tie this in with its corporate-owned store structure, that allows for easier facilitation between headquarters, the store level, and everything in between, including the supply chain. This allows them to roll out limited time offers very quickly and efficiently, as well as roll out regional price increases versus franchise restaurants who may see difficulty being efficient with these.
Yes, and this throughput on top of the significant white space that we're seeing, not only domestically, internationally, as well as the fact that with their improving ESG, we see a lower risk in the business model. Overall, we still see upside in addition to consensus. And while we do recognize that a significant amount of the growth is being recognized by investors today, because of this substantial growth, we see them quickly growing to this valuation over time and making it a strong opportunity still today.
Looking at the international expansion that you are forecasting, is that in line with management guidance on, and both the domestic expansion and the international, and particularly on the international side, why didn't they do it before if it's such a great opportunity?
Yes, I can start you off with that one. Thank you so much for the question. Jericho, if you can go to our international TAM, please. So Chipotle actually has started out, their previous CEO, Steve Ellis, he did expand internationally, mainly into the UK. And before he left in 2018, he pulled all of this back. But when Brian Nichols came in, the first thing he did was reopen up these stores. So these stores are still inside the stage gate process. And we understand that there are a lot of cultural differences in some of these regions. But due to Chipotle's modular menu design and using their staple foods, all these cultures are going to have to do essentially is just change the spices to whatever the preference is for the locals are. And so we believe that this is easily transferable outside of North America, and we think this will be very successful abroad.
Can you spend some time talking about the risk associated with store expansion? I know you had a slide per se that went through some of. I'd just love to hear more about the risk that you see that could happen.
Sure, yeah. We definitely recognize that there can be detrimental store expansion if they expand too fast or into non-strategic areas. We've seen this in the QSR market with McDonald's and Subway as two examples of store cannibalization. But what makes us very confident in Chipotle not seeing these effects is because more than 50% of the cities that could add a Chipotle do not have one already. And that's just representative of the massive amount of white space that they can expand into domestically and eventually internationally.
Yes, and additionally, to see the impact of this risk on our valuation, to see if it would impact our overall recommendation, we did conduct a store count sensitivity analysis to see what would happen if they did reach our same-store sales growth forecasts, but they did fall short of our overall TAM. And what we saw was that even if they don't reach our exact TAM, there's still significant margin for error for there to be upside in addition to that.
Well, I'm gonna link my second question with the first one, because maybe the alternative for customers is not going to another restaurant but staying at home, and because if they feel the pain of the price increases. So if we take this into consideration, do you think that the risk of investing in Chipotle is asymmetric because valuation and the multiples seem expensive?
Yes, I can start us off with that. So we definitely recognize that in addition to other restaurants, that overall price increases could detriment our same-store sales growth assumptions. And that could definitely be detrimental since that same-store sales does catalyze our margin expansion. So similar to same-store sales, we did conduct a sensitivity analysis to see what would happen if they did reach our store count growth rates, but they fell short on AUV and constantly didn't reach our overall margin expectations. And similar with the store count growth rates, we still see margin of error. And with the most recent quarterly earnings beating our AUV and margin expectations, we do see potential for even more upside. So with that, I'll go ahead and pass it to Sam to further explain why we are confident in the pricing power of Chipotle.
Yeah, another reason that we're confident in Chipotle's pricing power is, again, in their most recent earnings call, they did discuss how the strength of their target consumer hasn't really wavered. They often target higher income individuals and they haven't seen that demographic slip. And in fact, throughput from that demographic has increased in the most recent quarter, again, giving us confidence that Chipotle and their consumer are relatively resilient to that.
So from an international market standpoint, I know you talked about Europe as well as Asia. Is there any discussion or analysis of going to Mexico or South America?
Yes, I can start us off with that. Initially, we just wanted to focus on Europe and Asia for two reasons. One, because Europe has already been tested there prior, and Chipotle thinks that is going to be their next target audience. And we also included Asia as well because the quick service brands there have been significant, and we think that they can drive substantial unit economics there. And in terms of why we didn't include Mexico, Chipotle, we just don't think they'll be competitive, is the truth. And Chipotle has even said they have no intentions to expand towards Mexico for this exact reason. So for that reason, we don't see them expanding outside of those two regions.
Just again on the international expansion, I suppose, do you see the diversity within Europe, the UK being probably more similar to the US in terms of eating patterns, but a lot of differences when you look at places like France, Germany? Do you think there is an ability, I take your point on different flavors, but it's very different from the local, the successful food there. So what do you see it as a homogenous region or different areas within it?
So through the stage gate process, they've been constantly taking in data on both the consumer preferences and demands. And because of this robust stage gate process that they've been going through, and the fact that they haven't yet entirely focused on international because they still have their lofty domestic expansion to reach first, this gives us confidence that even when they're ready to fully expand and ramp up expansion in international, that they'll have the necessary preferences and demands of the local areas that they are already having their stage gate locations throughout Europe as of now.
Yes, and in addition, it goes back to our confidence with management. CEO Brian Nichols, he's had extensive experience at Taco Bell and their expansions in China. Before that, he also expanded with with Pizza Hut, and he created the Big New Yorker. So he's always been innovative and trying to go abroad wherever he's gone. So we have a lot of confidence in his team as well.
One major difference between Chipotle and the competitors that you've outlined in your slides here is quality, in my opinion, especially when it comes to the sourcing of ingredients. Could you talk about the potential supply chain impacts or risks that you've been able to incorporate into your analysis regarding the international expansion and any differences between Chipotle and those peers that you've identified?
For expansion and supply chain internationally, we tie that back into the stage gate process and that they're over there as of now, hopefully creating those relationships with those local business people, as well as their, like I said, the not yet entire focus on the international. So it just ties back into that stage gate research data taking in, as well as Brian Nichols, his success at expanding internationally with Taco Bell.
And in addition, we also want to mention that we would love Chipotle to maintain corporate owned in these international ventures. But if they have to in some of these more rural areas and some of these more untested markets for them, they do have the opportunity to franchise and get a local business partner that would help guide them into the right direction. So those are a few things that we see in helping them with international expansion.
And the capacity to finance the international expansion, is it with more debt? Because they have around 150% debt to equity ratio. I don't know if at some point the market could become a little bit worried about the leverage position of the company.
Yes, I can cover that question. The reason that we overall feel confident in Chipotle's ability to expand not only domestically but internationally in a organic way is mainly because of the significant amount of sales leverage that can be achieved from the same-store sales, and that not only improving margins but contributing to substantial free cash flow generation. And if overall we compare our operating cash flow that we're projecting compared to the capital expenditures that we're projecting over the next 10 years, we see that Chipotle has significant excess cash on top of
covering those stores. And we see them, as a result, having plenty of cash to be able to expand internationally as well.
Are you able to provide a quantitative upside to international expansion given you did analysis on the TAM?
Yeah, I can start us off. Our TAM and our forecast for now only incorporates 800 international stores. So we are projecting a lot of these stores after our forecast as Chipotle continues to focus on their more domestic expansion. After those 10 years are up, it could be much larger for all we know, but we see them primarily focusing domestic as of now.
Yes, and in addition to the 800 stores that we forecast within the next 10 years, the main area that we incorporated our international expectation is through our P exit multiple method, where we compared it to multiple other peers growing internationally and focused on international growth to see the overall valuation impact. And overall, we see that because of the substantial growth they have to add significant stores internationally, that contributes significantly to our valuation.
Do you see an impact on, I suppose, consumer preferences due to changing preferences with regard to on the individuals, but also in terms of the cost of living crisis and what people can afford? Do you see that fundamentally changing the market?
Yeah, I can start off there. We don't really see this fundamentally changing. Again, going back to the strength in Chipotle's primary target consumer, we don't see any increase of cost of living impacting, I guess, consumer preferences there. We're confident in both the company to be able to maintain its value proposition to its customers, as well as its target market to continue going back.
Oh, and in addition to the pricings, we do see some of these other international countries, their labor might be cheaper, so a lot of these operating expenses also might fall. So Chipotle will have the potential to hopefully lower prices as well to target the consumers of those regions.
Just the last point too, I think one of their main innovation techniques that they utilize constantly are their limited time offers. And these are their new seasonal, new types of proteins. They're also innovating with cauliflower rice, stuff like that. And the purpose of these LTOs is to draw in new customers as well as bring in their existing customer base more often.
Good afternoon. I'm Anais, and with me are Samantha, Benjamin, Brendan, and Jivitesh. We're initiating coverage on AMD, a designer of CPUs, GPUs, and other semiconductors. Products are vital to powering the world's computing devices. We issue a sell recommendation with a target price of $86, representing a 4% downside from April 28th closing price of $89. Strong cyclical headwinds, its weak economic moat, and geopolitical uncertainty support our sell recommendation.
The demand for semiconductors is driven by the dynamics of global computational device sales. And underlying our recommendation are two key characteristics of this industry. First, the demand for computer components is derived from the demand for computational devices. This means that AMD's economic success is ultimately sourced from the demand for computing end products. Second, PC lifespans have expanded to 8 years, leading consumers to replace their PCs less frequently. This means that today's PC sales will likely cannibalize future sales. Additionally, COVID resulted in a surge in PC demand, with analysts extrapolating this trend, resulting in AMD's overvaluation. And despite collapsing PC sales in 2022, analysts are still optimistic, predicting a swift recovery in Q3 2023. But taking into account excessive COVID-induced PC purchases and expanding lifespans, our analysis indicates that demand will fall well short of recent analyst expectations.
AMD designs integrated circuits developed on the x86 architecture for a wide range of computing applications. Manufacturing is outsourced to TSMC and Global Foundries. The business consists of 4 key operating segments. The embedded segment services automotives, industrials, and IoT devices, with the $49 billion acquisition of Xilinx contributing to growing revenues in the space. The data center segment provides cloud solutions and data processing for companies like Microsoft, Google, and Meta. The client segment serves original equipment manufacturers like HP, Lenovo, and Dell, while the gaming segment powers graphics for PCs and gaming consoles.
The industry is comprised of foundries, which are pure-play manufacturers, fabless design firms like AMD, and IDMs, which both design and manufacture products. And the industry primarily sources its revenue from 3 countries: the US, China, and Taiwan. Additionally, the primary catalyst for semiconductor growth will be AI, with TAM expected to grow at a 34% CAGR through 2025. The AI revolution requires significant computational power and speed, and while AMD does produce GPUs that are capable of parallel processing, the market leader NVIDIA is likely to dominate this space in the near future, placing AMD at a disadvantage in the crucial battle for AI market share in both the data center and embedded segments.
Headline inflation is trending downwards, but continued labor market strength has resulted in PPI growth and elevated services inflation. In response to persistent high inflation, central banks have been aggressively raising rates, bringing the Fed fund rate to 5%. Yield curve inversion, the deepest since 1981, suggests high probability of recession. Additionally, the current banking liquidity crisis has increased contagion risk, further tightening financial conditions. These factors put downward pressure on demand for computational devices and consequently semiconductor products.
There are 3 key drivers supporting our sell recommendation, with the first being cyclicality faced by AMD and the industry. COVID's work-from-home conditions created abnormally high demand for AMD's products, with year-over-year sales growth peaking at 68% by 2021. This spike in chip demand led to a rapid expansion in supply capacity, resulting in accumulating inventories and the erosion of pricing power. Industry cyclicality stems from the need for companies to continually introduce new product lines, requiring significant upfront investment. Additionally, computational devices are semi-durable goods. When a recession occurs, demand for these products suffers, adversely impacting downstream revenues. In anticipation of recession, memory, motherboard, and chip prices have been slashed in recent quarters, compressing margins industry-wide.
Second, intense competition from Intel and the encroachment of the ARM chip architecture significantly weakens AMD's economic moat. AMD and Intel operate in a duopoly when it comes to the x86 market and produce perfectly substitutable products, making consumers price sensitive due to minimal switching costs. Now, AMD has been able to produce competitive products in recent years, whereas Intel has struggled internally. However, we do not believe that AMD will be able to outperform Intel in the long run. Intel still holds the majority of the x86 market share and has a higher cash position, allowing it to outspend on R&D. Moreover, its strong financial position allows it to implement aggressive pricing strategies that may undercut AMD's. The ARM chip architecture also boasts greater power with higher energy efficiency, making it an increasingly viable alternative to x86, especially when it comes to PCs and data centers. Apple has already implemented ARM in all of its devices, with Amazon and Google following suit in their data center operations, further dampening the growth outlook for x86.
Third, the China-Taiwan conflict presents a significant risk to AMD. Recently, tensions have escalated as a result of increased U.S. military activity in Taiwan. Escalation of conflict could imperil TSMC fabrication. As a result, AMD's manufacturing costs could skyrocket, severely compressing its margins. AMD derives 38% of its revenues from the Chinese and Taiwanese markets. Comprehensive sanctions could impair AMD's operations. Finally, supply chain fragility could drive customers away from fabless designers towards vertically integrated IDMs like Intel.
We developed our own econometric model to project AMD's revenue growth that accounts for our key drivers. This model links sales growth to global PC unit shipments, consumer prices for computers and electronics, and semiconductor profitability. Based on this model, we project a 5-year sales CAGR of 15%, which is consistent with AMD's average long-run growth. As you will see further, under a base case, we expect COGS and R&D to grow in line with revenues, with considerable variation under a best and worst case scenario. We also expect margins to remain consistent with short-run averages going forward.
In order to value AMD, we constructed a DCF valuation under 3 scenarios. And for each scenario, we took into account macroeconomic conditions, industry factors, and firm-specific assumptions. We then went to the forward-looking options market to calculate the weights for each of these scenarios by deriving market-implied probabilities. We also utilized a Monte Carlo simulation to account for the uncertainty in our DCF and simulated a variety of drivers. Now, AMD's capital structure is nearly all equity. Therefore, for each scenario, the free cash flow to equity and terminal value have been discounted at a dynamic cost of equity instead of a WACC. This cost of equity falls over time as AMD matures and its beta shrinks. To complement our DCF valuation, we conducted a relative valuation comparing AMD to 10 of its industry peers. Using median peer multiples, yielded a fair value of $69. Finally, we developed our own novel econometric model that links AMD's price to the fundamentals of the semiconductor industry. This model links AMD's price to the value of computer shipments, the production of computer components, and the production of circuit boards, and yields a fair value of $71. Our final fair value of $72 is a weighted average of these three models, and our target price 1 year out of $86 represents a rate of return 23% below the required rate of return as relative to the market closing price on April 28th.
Recently, greenwashing and ESG manipulation has become an investor concern. Accordingly, we've adjusted our ESG scoring systems to reflect the quality of rating agency. Using these weights, our ESG scoring system is a weighted average of FactSet, Morningstar, and Refinitiv. AMD scored below its key competitors in the industry. 33% of AMD's board are women and 22% are racial minorities. Additionally, AMD must comply with regulation on disclosure of conflict minerals and ensure that there are no occurrences of forced labor in their supply chain.
We identify the following significant risks to AMD. First, the US banned the export of AI computing chips to China. Additionally, Intel is the primary beneficiary of the CHIPS Act, with much of the funding being allocated to expanding manufacturing capability in the US. The Made in China 2025 plan aims to onshore both designing and manufacturing of semiconductors to China. Second, the inability to retain talent can lead to less innovative and less competitive products. Semiconductor engineering is highly specialized, and talent scarcity can lead to fierce competition among industry rivals, with AMD's main competitors being better positioned to acquire talent. Downward trends in skilled immigration since 2016 further intensify this problem. These risks, in addition to other operational and market risks, have large valuation impacts should they fully materialize. To close, we restate our sell recommendation based on AMD's weakening economic moat, geopolitical uncertainty, and strong cyclical headwinds. Thank you. We'll now open it up for questions.
Can you justify your use of a DCF valuation given that the stock is actually really cyclical and follows the semiconductor cycle?
Absolutely. We use our DCF mainly because it is an industry standard and would have been very difficult to leave it out, although this cyclicality was really implemented in our model overall to value the company. And we also valued it the most, added the most weight to it compared to two other models that yielded our fair value of $72.
When you look at our other models, they all reinforce each other. That DCF intrinsic value has a value of $72. The comps has a value of $69. And then that industry model reinforces both of those with a value of $70. So that's why we have so much confidence in each of these three valuation models that were all developed in parallel but separately.
To quickly add on to that, our DCF valuation allows us to take into account time and to analyze intrinsic factors that affect AMD, and we felt that that was vital for our valuation. And because it allows us to take into account time going forward, we can also take into account further cyclicality and factors that come up.
Well, not all processors are made equal, and this is a technological company in which technology should have an edge against competitors. They recently presented 2 new processors, but I couldn't understand how much of a competitive edge do they have against competitors. Could you please explain me a little bit on their positioning?
So AMD is positioned in the middle market. While we do understand that not all processors are created equal, in the consumer's mind, the consumer looks at it from a performance to dollar ratio. So Intel operates in the lower and middle markets. AMD really focuses on the middle market. And then we have companies like NVIDIA that operate in that high market with GPUs and stuff like that. So that's AMD's strategy. That's where it lives, in that middle market. And we don't see too much of a performance advantage as you go through those markets. Moore's law is considered to be dead in the computing industry. So with each added improvement in product roadmap that these companies come out with, you're not seeing the added compute gain when you move through those products.
To add on to that, Benjamin, if you could go to the intellectual property analysis, we can see that AMD in a few years, so in 2016, they really had an increased growth in filing grants for patents. However, since 2019, it has really been stagnating, and we can really be questioning their ability to innovate in the future and come up with new products that will actually compete with big competitors like Intel and NVIDIA. And to add on to that, if you could go to Intel's cash position, Intel has a much higher ability to invest in R&D due to their high cash reserve and just their ability to make R&D go into their patent portfolio, and they're increasing. They're the 5th largest patent holder in the world, so you can really see that their R&D is translating in new patents and new products.
Adding on to that, AMD has been increasing its R&D spending, and yet we're still seeing this stagnation in innovation and patent filings.
You commented on the exposure to China. What do you think in terms of that exposure? Why is your expectation so different from the market? Is that issue not already priced into the stock?
Yeah, so thank you for asking that question. In terms of what our recommendation is different from the market, we are pricing a very low probability. Our worst case incorporates a China-Taiwan event, and that is less than 2%. But the fact that it has such a large impact on valuation, we can see that an elimination of Taiwanese and Chinese sales would cause a 46% drop in AMD's valuation. We took the Russia-Ukraine war as kind of a really poignant precedent for the kind of sanction regime that could result. And on the point of what we know different from the market, we believe that the market is actually is expecting the PC market to recover more quickly than we believe it is. We saw after 2008, it stagnated for close to 10 years. And we believe that the market is overestimating the probability that that market will return quickly.
I'd like to follow up on the question. Despite the sanctions that US have issued on China with regards to the chips, AMD was actually able to redesign the chips to circumvent the sanctions. Can you comment on that?
Yeah, so AMD, they had their MI250 chip banned to China, and they are still offering their MI300 chip to them, and that was actually not a major revenue driver for them, but we see it as kind of a really interesting indication of where the regulation regime could go in the future. If we see a tit-for-tat situation occur where it occurs with less and less advanced technology, that could really put downward pressure on AMD's ability to operate in these markets over the long run.
Yeah, we're really looking at that as a signal to what new products could face, what risks that new products could face coming down the line.
Well, we have a pretty recent news because the company reported yesterday, and they lowered the future guidance. Even though they beat expectations on this quarter, they lowered the guidance. Maybe that is consistent with the thesis that you are presenting us here. But I don't know if you had the chance to see if the guidance meets or matches your expectations, or there's still more pain that is not on the guidance.
So our analysis is based on the fact that PC unit shipments are going to continue to deteriorate. Our analysis actually overestimated what the PC market did in that recent earnings report. The IDC reported 56.9 million PC shipments in Q1, and our analysis forecasted 62 million. So we're off a little bit. However, the market continues to see that rebound in Q3. And AMD, Lisa Su, did note yesterday that she sees a rebound in Q3. However, we see a transition away from PCs as a result of this COVID exuberance and these higher life cycles. So people that bought a PC during COVID, they're not going to need to replace that for 8 more years. So we don't see the justification on that PC market rebounding in Q3 23.
And to add on to that, we can also see how the utility of PCs has been changing over the past 2 decades. And as Benjamin mentioned earlier, after 2008, PC sales declined. And that was mostly at the same time that there was a rise in use of cell phones, tablets, and other computational devices, and therefore people switching either in between a different device and a PC. And now during COVID, this demand was exacerbated. People bought PCs, and with the expanding life cycles, will hold on to those PCs for a much longer period of time. And it is also important to note that when it comes to other devices such as cell phones and tablets, AMD has a very weak foothold in those because most of those run on the ARM chip architecture. And that's why we believe that this PC slump, as AMD currently stands, will be detrimental to their future growth prospects.
Maybe could you talk a bit about your approach to valuation, just how you came about the split? And part of what's behind my question is just looking at some of the different valuations. It looks quite bear market. I know a lot of the information you've presented as such. I'm just wondering, did you go low enough on your final target recommendation? But would love to hear you just talk about the valuation.
Yeah, we gave our DCF valuation the most weight given that it's the industry standard, and then followed by our comps valuation because again that's another industry standard, and then our novel regression model just further reinforced the prices that we got from those 2 other models.
Yeah, and so our approach to valuation really centered on, how can we justify what the current market price is? What are the assumptions that are necessary to come up with that price? And then do we really agree with that? So that price, we calibrated our model to the current market price, and that resulted in growth that was significantly higher than their long run growth. And we don't see that happening given the derived demand story, the PC units. We don't see that as justified, so we had to go back through all those assumptions, lower the margins, lower the sales growth, and that's kind of how we arrived at our intrinsic valuation. Happy to explain more if you're thinking about something specific on our approach.
In terms of raw materials, what is your exposure to raw materials that comes directly to them, and also the interaction via TSMC in terms of raw materials? Does that also flow through to AMD?
Yeah, so AMD does not do any manufacturing of their products. So most of the raw material costs, input costs of that sort, are going to be borne by manufacturers like TSMC and then Global Foundries, which is their manufacturer for the lower market items. So AMD actually does not have a significant exposure to those types of input costs.
And do they get it passed on via TSMC?
Yeah, so in that most recent report, we saw margins compress, gross margins, which is the direct result of higher input costs from TSMC, and they're passing on. They are the market leader. They have a lot of pricing power. They manufacture the most advanced chips across the world for Apple, for AMD, for all these tech firms. So they do have quite a bit of power.
Moreover, another important thing to note is, Ben, if you could go to the supply chain map, is the supply chain for semiconductors is global, and a lot of different nations and regions contribute towards providing raw materials as well as human capital for the production of semiconductors. And due to this, due to the amount of suppliers and how all of that concentrates towards these few products that AMD manufactures, we can see that AMD currently being completely fabless and not manufacturing their own firms is to some extent, a major extent, at the mercy of these suppliers and the raw material costs that kind of get carried over into the production of the chips that they design.
You mentioned the Xilinx acquisition. Are there any synergies that have yet to been realized from that deal that you anticipate having a positive impact on AMD in the near future?
Xilinx was their latest acquisition as of today and their largest one, especially for the industry. They have declared that they do not plan on acquiring any other company anytime soon, so we don't see it happening. However, if they were to expand, we would say that it would be beneficial for them to acquire a company that's probably in the AI industry where they can have a foothold in that door, especially.
Ben, could you pull up the business segments? So AMD actually wasn't operating a lot in the embedded segment, which is how they refer to Xilinx. So as if you can look at 2021, the embedded segment was basically non-existent. And so the addition of Xilinx contributed to a whole nother segment for them. So that's kind of where the synergies are coming in. And we see growth in that sector. So that's where a lot of the growth is going to be for them instead of the synergies, if that makes sense.
And I would add that that acquisition actually put a massive amount of goodwill on their balance sheet. So it's opened them to a large impairment risk on the bottom line for the next few years. So while they're digesting that, it would be hard to initiate any more merger acquisition activity.
You have a 6% downside to your target price. Would you say a lot of the cyclical headwinds and the risks you mentioned are already priced in?
So our target price is the result of our intrinsic value grown at our cost of equity. So while our target price is $86, the intrinsic value today of AMD is closer to $72. So the answer to your question would be no, there's still a lot of downside to price in. I believe the number is 23%.
I have no more questions. Thank you very, very much.
Thank you all for your time.
Are you tired of struggling to find the perfect temperature at home or work, or in this hotel? Let's face it, traditional heating, ventilation, and air conditioning systems, known as HVAC, can be a headache. But what if we told you that these small orange devices are changing the game? With energy-efficient solutions that save you money and reduce your carbon footprint, Bilimo is the ultimate win-win. Today, we're excited to share why by investing in Bilimo, you're not just investing in a company, you're investing in a brighter, greener future for all. We strongly believe that the potential of Bilimo devices is currently undervalued. Therefore, we issue buy recommendation with 17% upside and a target price of 501 Swiss francs. We base our recommendation on the following 3 catalysts. Firstly, Bilimo is best positioned to benefit from energy transition. Secondly, Bilimo's ability to thrive through premium pricing. And thirdly, Fortress financial foundation to capture growth and secure future success. Bilimo offers a wide range of HVAC control solutions as damper actuators, control valves, and sensors to control air and water flows in HVAC systems. Geographically, the main region for Bilimo is EMEA, which accounts for 49% of total revenue, followed by Americas and Asia Pacific. With digitalization ramping up in Americas, urbanization booming in APAC, and climate change impacting us all, these favorable trends propel future growth of the HVAC industry. We expect climate change and energy transition to be the strongest drivers of HVAC market growth. And here is why. To meet climate goals, energy consumption of buildings has to be reduced, as buildings consume up to 40% of global energy. For buildings to become more energy efficient, HVAC systems have to be optimized. As many countries globally fall behind to reach net zero, more and more building energy codes are introduced. New regulations emerged in Europe in response to EU energy crisis. New Repower EU regulation doubles all previous renovation and climate targets. Energy-efficient HVAC market growth is expected to accelerate due to positive push and pull dynamics. Regulations push building companies towards energy efficiency, while increasing electricity prices created a pull effect by reducing the payback period. This results in clear purchase benefits for Bilima's customers and faster retrofit market growth. As EU aims to end its reliance on Russian fossil fuels by 2027, EU is required to double renovation rates to 3%. This translates to the highest sales growth in EMEA by 2027. We project positive growth in all regions where EMEA is the main growth driver. Belima will have above industry sales growth and expand their market share. Now Tutku will tell us why would it be feasible.
Belimo will thrive and grow through premium pricing. First thing explains premium pricing is that Belimo produced best energy efficient solutions. Belimo invests 7% out of sales in R&D annually. This is significantly higher than their competitors. Belimo provides the best energy-efficient products, consuming up to 80% less energy than their competitors. Secondly, premium pricing is justified due to quality and longevity of Belimo's products. Belimo's products are tested rigorously, which results in the lowest failure rate in the industry and up to 20 years of useful life. Therefore, Belimo's products are attractive from a total cost of ownership perspective. Customers are willing to pay premium price to receive premium products. This results in Belimo having justifiably higher and stable margins of 17% for the last 5 years. It is higher than the competitor average of 8%.
We project strong margins going forward. We believe that Belima raises prices beyond what is necessary to offset rising input costs, meaning it exploits current inflationary environment as an opportunity to increase prices more than necessary to boost profit. For instance, in September 2022, Belimo incorporated an extraordinary price increase of 6%. We expect 2 price increases this year as a result of HVAC price increases affecting the entire industry. To summarize the margin development, let's have a closer look at the EBITDA bridge. Firstly, premium pricing will result in lower material expenses as a percentage of sales. Secondly, labor shortage and labor inflation will affect personnel expenses negatively. Altogether, EBITDA margin will improve by 250 basis points. Tutku, what is the growth outlook for Belimo?
Belimo has financial strength and flexibility to support growth. First, Belimo has an asset-light business model since 86% of production costs are outsourced. This business model allows Belimo to scale globally without incurring additional investments in fixed assets. Belimo's low capital intensity leads to an outstanding performance with an unmatched return on invested capital of 26%, enabling future strong free cash flow margins. Secondly, strong foundation of the balance sheet lies in Belimo's capital structure and healthy liquidity. With the superior current ratio and 167 million of net liquid assets, Belimo can afford additional capex. Moreover, low debt results in less financial and cash flow risks. This further implies low default risk, which is also supported by Altman Z-score and distance to default. We reflected to our valuation through a lower beta than the industry and their peers, which now brings us to valuation. In the context of ESG, Belimo performs well in indirectly reducing carbon dioxide emissions and providing adequate working conditions. However, when it comes to gender diversity in management level, we think that they can do better. Maybe they can learn from us. Overall, Belimo has not been involved in any major ESG controversies to date, which makes Belimo an attractive investment for ESG-conscious investors. Our ESG scorecard, combining our own insights with Refinitive's view on ESG, confirms Belimo's strong ESG credentials. Nonetheless, empirical evidence shows that the difference in cost of capital between high ESG and low ESG scoring companies in the industrial sector is 40 basis points. Therefore, we assign 10 basis points on WACC. Incorporating ESG analysis lets us ESG adjusted WACC of 6.5%, which is very close to cost of equity due to Belimo's capital structure. Our multi-stage DCF valuation results a target price of 501 Swiss francs, and our sensitivity analysis supports our buy recommendation. Our gray sky scenario analysis showed a limited downside, where we simulated a loss of revenues due to failure to capture growth in EMEA. Nonetheless, blue sky scenario analysis resulted in stronger sales thanks to both organic growth and a successful acquisition. To further enhance our valuation methodology, we conducted relative valuation.
We formed a comprehensive peer group. Multiples analysis has showed that Belimo trades at premium. Belimo has superior ROIC, highest earnings growth, and EBITDA margin, which justifies the premium. We can see that high EV/EBITDA multiple is in line with high earnings growth. We believe that the premium is justified. Belimo has superior earnings growth and high earnings quality. High earnings quality is sustainable and will persist going forward. This ensures quality growth and justifies Belimo's valuation premium. To come up with our final target price, we rely on DCF valuation, which results in a final price of 501 Swiss franc. And we see no high probability, high impact risks that could disrupt Belimo's growth. To sum up, we identified three main drivers that underline Belimo's highly appealing perspectives. Don't let your portfolio get left out in the cold. Thank you.
Could we slide back to slide number 13, please? Could you just talk about the difference between the competitor and peer groups that you generated and how you came up with each of those on the left side of this slide, please?
Yes, absolutely. In our analysis, we distinguish peers from competitors. As Belimo is a niche player and focuses on developing field devices for HVAC systems, and their main competitors, Siemens, Honeywell, Johnson Controls, and Schneider Electric, they compete with Belimo only in a small niche. They're big conglomerates that not only produce products for HVAC systems, but also many different products, and they also have different growth, different underlying fundamentals. Therefore, we believe that competitors are not appropriate to be peers. And to construct a peer group, we analyzed the companies that operate in HVAC industry, and we found out that there are no truly comparable peer set for Belimo, as they also produce not only field devices, but also radiators and other different devices for HVAC systems.
Thank you.
You have EMEA recording the highest growth historically, and this is largely driven by regulation and the need for energy transition. But do you expect them to command similar kind of market shares and growth in other regions?
Yes, we expect Belimo to increase market share in other regions. For instance, in 2022, there was a supply chain crisis, material shortage, and inflation crisis. But Belimo could be able to surpass these problems, and Belimo increased their market share in every country in Europe and Americas region, and we expect them to increase their market share in Americas too, but not in APAC region, because we believe that Belimo underestimates their competitors in APAC region. So we expect moderate sales growth in APAC region, but not a high increase in market share.
So one of the things that you mentioned as a benefit is that they outsource a lot of their business model. Can you talk a bit about who they're outsourcing to and what risk, if any, that outsourcing brings?
Belimo has a satellite business model. They don't produce their products in their facilities. They assemble their products and they label them with their tags, but 86% of production costs outsourced, and 9% is for logistic, and 5% is for customizing and assembly. And they are relying on their suppliers. They have more than 400 suppliers, and they depended on their each supplier is like 20 or 30%, and they buy their materials and they just assembly and then they deliver to their subsidiaries or OEMs.
Do you think that model puts them at a disadvantage in terms of achieving the growth rates that you're expecting?
We think it's not a problem. Actually, it's an advantage for Belimo. For instance, in 2023 in Americas region, there was a supply chain crisis. Most of the firms were struggling to find raw materials, but Belimo increased their sales in local currencies by 20%, which was unexpected. We think that outsourcing is an advantage for Belimo because they don't. If there is like a crisis, like raw materials or logistic crisis, they do not have these problems because also they have inventory build-up system. They buy their materials in advance and they stock. So we think it's an advantage also, yes.
Well, the company flagged recently some short-term challenges. For example, labor shortages, supply chain concerns. Do you think the company has the pricing power in this competitive landscape to face these challenges?
Yes, thank you for your question. We reflected labor shortage in our gray sky scenario analysis. We believe that indeed, as in HVAC industry, there are not enough qualified specialists that can install HVAC products efficiently. And we believe that it will not be a constraint. It might be a constraint for Belimo. However, they have strong pricing power, as historically they were able to pass on rising input costs to their customers. And this we can see in increasing margins from 2017 to 2022. And therefore, due to its pricing power, we believe that Belimo will thrive and grow through premium pricing.
Just on that, you noted that you expected the premium pricing to drive even higher margins in future. You had one chart, sorry, I think it was chart, anyway, page 11, where you expected an additional increase in the EBITDA bridge. Is that a further gap on pricing, additional premium pricing going forward? And, given the comments you had, how do you think that's achievable?
Yes, we believe that Belimo has a strong pricing power, and this ultimately contributes to our margin projection. And also we expect inflation to decrease by 2026, which will further support the expansion of margins.
Another question regarding the company capabilities. The industry is facing structural changes regarding energy efficiency and also improving indoor quality of the equipments. Does the company have the latest technology on this?
Yes, Belimo invests 7% out of sales in R&D every year, and it is significantly higher than their competitors. Even the competitors are big companies like Siemens, Johnson Controls, but their HVAC field is relatively small compared with Belimo. And yes, Belimo follows all of the technologies, and since they have asset-light business model, they don't have tangible assets, fixed assets, so they can invest their cash to new technologies and R&Ds.
And as you may see on the slide, since their founding year, Belimo was continuously introducing new products to the market. And recently in 2020, they even expanded their product offerings and entered new sensor segment. It proves that Belimo is very efficient with their R&Ds and continuously innovates ahead of its competition to satisfy the demand of the clients.
Can you talk a little bit about the end consumers for these products, or is Belimo selling to a retail audience in, say, a big box store? Are they doing business directly with contractors? And if it is the latter, or if there is a significant percentage that are sold directly to builders, are you concerned at all about the housing market's impacts on Belimo's ability to continue to grow revenues?
Belimo mainly serves non-residential segment, 95%, and 5% is residential segment. So they have distribution channels all over the world, and they're B2B provider. So they do not sell directly to the clients, but rather to OEMs and building advisors. And we believe that it's an advantage for Belimo, and also because Belimo prioritizes their relationships with customers and these building automation systems. They are delivering products swiftly, which is a great advantage for them.
I guess there's significant challenges on commercial real estate in Europe. Is that a concern? Do you think that's a major concern if we see, problems coming through to that market?
We don't see it as a major risk because we see great potential of Belimo to capture the growth in EMEA. Given EU energy crisis and that 85% of building stock in Europe is energy inefficient, and Belimo offers best solution to this issue. And given recent developments in regulations, like new REPowerEU regulation, European countries have to double renovation rates to 3%. So Belimo is best positioned to capture growth and expand in retrofitting.
I might ask another question. Obviously, Europe is very different in terms of the regulatory environment and what's happened previously. Does that drive different profitability by region? With different subsidies provided, does that impact the margin?
If I understand correctly, regulations is the main driver for EMEA region, but for Americas region and APAC region, the drivers are different. For Americas region, the main driver is the data center segment. We expect moderate sales growth in Americas region because main focus is on EMEA. We expect 9.2% of CAGR for the next 5 years. It is higher than Belimo's past 5 years, but it is lower than the data center CAGR. In APAC region, we expect Belimo will increase their sales due to Chinese and Swiss government have launched an agreement called Chinese Zero Energy Buildings with Swiss know-how. Chinese government lags in implementing energy efficient technologies in their buildings, so they will get help from Swiss companies, especially expertise in HVAC field devices like Belimo. We expect that Belimo will benefit from this agreement, yet Belimo underestimates their presence and their competitors' presence in APAC region. So we expect Belimo to increase their demand and sales in APAC region, but it will be slower than their expectation.
And is there a difference on the margin between the regions as well?
Yes, so APAC represents only 13% of sales, which has a limited impact on margins. And we believe that the Belimo's ability to raise prices and premium pricing will contribute to margin expansions, and it's mainly driven by EMEA.
So they have a competitor, I think, listed in Germany called Knipe Industries. However, Belimo actually commands superior margins and ROEs compared to the peer. Why do you think it trades at a discount, though?
Yes, Belimo indeed has superior margins compared to its competitors. And as we mentioned earlier, because Belimo offers best energy efficient products and also that they have very high quality and long useful life, therefore customers are willing to pay for that premium and accept the price increases, which further supports the margin expansion.
Okay. With no further questions, thank you very much, University of Neuchâtel.
So, I am delighted to announce the winner of the 2023 CFA Institute Research Challenge is the University of Sydney. Way better in real life. Again, congratulations to each and every one of you. It is hard when you're all here at the finals to know just how extraordinary an accomplishment this is. Sydney, congratulations. Enjoy the rest of the evening.